All right, let's dive right into this explainer. We're going to unpack the massive, honestly mind-boggling 335-year journey of Barclays. It's wild to think about how a tiny, humble London goldsmith operation transformed into one of the most systemically important financial institutions on the face of the earth. It's a name you probably see everywhere, but underneath that familiar blue logo is a corporate history filled with aggressive expansion, high-stakes survival, and some really deep controversies. To make sense of this, we're going to break things down into 5 key themes. We'll look at their scale as a global banking behemoth, their 3 centuries of history, navigating the 2008 crisis, the scandals and controversies, and finally, how they're restructuring for the future. Starting off with Section 1, a global banking behemoth, focusing on their modern scale and reach. Let's start with a number that's honestly hard to wrap your head around. 1.544 trillion pounds. That is Barclays' total assets as of 2025. To put that into perspective for a second, that's roughly the entire economic output of a medium-sized country, all sitting under one corporate roof. It firmly solidifies their place as Europe's 5th largest bank. This is a figure that literally moves markets all on its own. And when you look at the modern footprint, it's just staggering. They operate in over 40 countries and employ 100,000 people as of 2026. They're a massive constituent of the FTSE 100 index. But maybe the most crucial point here is that they're designated as a globally systemically important bank. In plain English, if Barclays sneezes, the entire global financial system catches a cold. With over £29 billion in revenue generated in 2025 alone, they hold an immense level of influence over global financial stability. Let's move to Section 2, 3 centuries of history, taking us from goldsmiths to ATMs. So you don't build a trillion-pound institution overnight, right? We have to rewind back to 1690. Picture this, just 2 Quaker goldsmith bankers, John Frame and Thomas Gold, setting up shop on Lombard Street in the city of London. Back then, banking wasn't spreadsheets and algorithms. It meant literally safeguarding heavy precious metals. They were the original vault. By 1728, they moved into a building identified by the sign of the black spread eagle, which, fun fact, became a core part of their visual identity for centuries. Now, getting to the modern era wasn't a straight line. The big leap happened in 1896, when 12 private banks across London and the provinces decided to unite as a joint stock bank under the name Barclays & Co. That's when the modern corporate entity really began to take shape. From there, it's a story of pioneering moves. In 1968, Barclays appointed the UK's first female bank manager, Hilda Harding. And in 1967, they literally changed how we interact with money by deploying the world's very first ATM in Enfield. British actor Reg Varney was actually the first person to use it. That brings us to Section 3, navigating the 2008 crisis. This was a massive fork in the road. When the 2008 crash hit, the ground was falling out from underneath the banking sector. Survival required unprecedented split-second decisions. Barclays was facing a huge choice. While many of their peers took the easier route, accepting a UK government bailout that came with heavy operational leashes, Barclays emphatically said no. To maintain total independence, they scrambled to raise £6.5 billion privately. They relied heavily on Middle Eastern investors, prominently from Qatar, and they made the painful choice to slash £2 billion of their own dividends. And that fight to stay independent, it paid off almost immediately. Because they weren't tied down by government restrictions, they could swoop right into the absolute chaos of the Lehman Brothers collapse. They bought up Lehman's North American investment banking operations and headquarters for around $2 billion. In the middle of absolute market terror, Barclays essentially bought themselves a top-tier Wall Street investment banking franchise at a massive discount. It was an incredibly bold move. Which leads to Section 4, Scandals and Controversies, exploring the regulatory and public backlash. Now, growing at that breakneck speed and navigating complex international waters definitely comes with severe exposure. The 2010s heavily bruised the bank's reputation. The most notorious issue was the 2012 LIBOR scandal. They were fined over £290 million for manipulating global interest rates, which forced CEO Bob Diamond out. But it didn't stop there. They had to disband a highly specialized division that critics dubbed a secret tax avoidance factory, generating £1 billion a year. There were massive £299 million fines from U.S. energy regulators, intense public backlash over funding the Mugabe regime in Zimbabwe during the late 2000s, and more recently, ongoing protests from groups like Share Action targeting their $85 billion footprint in fossil fuel investments. Finally, we reach Section 5, Restructuring for the Future, and how they are paving a simpler path today. Because of those intense regulatory pressures and market shifts, the bank realized the era of being all things to all people everywhere was officially over. They had to radically streamline the ship. This meant making some tough choices. Take their historical roots in Africa, for instance. Despite strong local profits, strict new global banking regulations required the parent company to hold vast amounts of capital against those African assets to maintain their capital adequacy ratios. The math just broke. It forced them to sever deep historical ties and sell down their African operations in 2017 just to keep the parent company compliant. This all culminated recently in early 2024. Driven by CEO C.S. Venkatkrishnan, the bank executed a radical simplification strategy. They broke the behemoth down into 5 distinct, evenly balanced divisions: the UK Consumer Bank, UK Corporate Bank, Private Bank and Wealth Management, the Global Investment Bank, and the US Consumer Bank. It's a calculated move to shed that confusing complexity that caused them so much trouble in the 2010s, making the entire business far more transparent and efficient for regulators, investors, and clients. So that leaves us with a pretty fascinating final thought. We've watched two goldsmiths evolve into a trillion-pound global titan, surviving world wars, the 2008 crash, and their own self-inflicted scandals. But as the financial world becomes faster, more highly regulated, and fiercely competitive, we have to ask, will this massive pivot to simplicity truly future-proof one of the world's oldest banks? Or is the hardest part of their 335-year history just beginning? Thanks for joining me on this explainer, and I'll catch you in the next one.